Welcome to the latest in our restructuring video series. We've got Jack Caller here this morning. Good morning.
Good morning, Luke. How are you?
I'm good. You doing okay?
Very well, thank you.
Good. So we're talking, it's a bit technical, but we're talking in specie distributions in the context of a solvent liquidation today. So tell us a little bit about what that actually means, first of all.
So the first thing to say is I'm going to make it as untechnical as I possibly can.
Good.
And I think it's worth setting a scene. So we've talked a lot about solvent liquidations in this series already. I'm going to take you right up to the point where we've got a company with nothing but cash in it and it's ready to go into solvent liquidation because it's the most tax efficient way to extract that money and put it into the shareholders' hands.
Yep.
So that is what we'd call a basic solvent liquidation, something we see a lot of. And that scenario is we've got cash in the bank. We usually have a final HMRC corporation tax liability to settle because there's always a period of corporation tax ending just prior to liquidation. And once it goes into liquidation, we deal with that cash and it's relatively straightforward. There are scenarios, however, where we have more than cash to deal with. And it can be any asset within a balance sheet. It could be a trade debtor. It could be a director's loan account. It could be a motor vehicle. It could be a property. It could even be some shares. And for whatever reason, that asset has not been converted to cash prior to it coming to the liquidator. And that can also be for many reasons. Some of it's just timing. There may well be a reason to accelerate the pre-planning process to get the company into liquidation. Or it could be that actually there's no desire by the shareholders to convert that asset into cash. They might want to keep the property or the motor vehicle.
Yep.
So that's the scenario where distributions in specie come into play. And it is simply distributing an asset to a shareholder without first converting it into cash.
So it's a paper distribution, effectively.
Absolutely, with the impact of transferring ownership of that asset onto the shareholder so they can keep their hands on that asset without first converting
I think
it into cash.
you've possibly answered my next question. I was going to say,
ask it anyway.
But I'll ask it anyway. So I was going to ask, when is a distribution in specie appropriate?
Yeah. So going back to the first reason on timing, I've seen personally a number of scenarios where the liquidation needs to happen, and it could just be because someone's maybe tried to sell the business and it hasn't gone to plan, and actually the directors had enough of it, and let's just cease to trade and put it into a formal process.
Sure.
It might be because it's a book debt, and the book debt's not going to be paid because there's an ongoing dispute with it, or the due date just isn't for 3 or 4 months' time, but the director doesn't want to continue to have to deal with the business without it going into liquidation. So that timing is a real play, and I think that the key takeaway for anybody who's in this situation, considering ceasing to trade or selling their business and going into a solvent liquidation, is that assets don't need to be in cash form. So there's always a conversation around strategy and planning the liquidation process. With costs in mind, but the asset can still be intact when it comes into liquidation. The other one is just about desire, as I said. We see many cases where property is a very common one, where they might have interest in renting that property as a retirement asset, for example. Directors' loan accounts are quite a big play. This is where the directors will typically the director is the shareholder in most cases. It can work without, but it gets a little bit more complicated because the director in effect owes the company money.
So it's a loan between the company and the director.
And it could be a circular. The director could repay the loan. The cash comes into the business, but then the cash goes back to the same person as a shareholder. So you can
kind of question the point.
It just adds costs and time to the process. So you can distribute the right to receive that loan account money to the shareholder, and effectively they're allowed to repay themselves, if you want an untechnical phrase. That just simplifies the process and adds a commercial, practical angle to the fact that distribution in specie would come into play.
Okay, and the other thing, if I could just add one thing to that around timing, which is always quite interesting, in the lead up to a budget, for example, when there's there tends to be fear every single year that we do these, although a lot of that fear doesn't seem to manifest into anything, thankfully, although there have been some changes. The distribution in specie gives you an opportunity to distribute, doesn't it, ahead of a budget, for example, which again ensures that you're locking in the tax treatment at that current time. So it avoids a bit of risk potentially.
100%.
So pitfalls, then there must be some.
Yeah,
it all seems too easy. What
there are a couple of perks, for sure. For example, on property and shares, it doesn't attract stamp duty. So that's always something to consider. And obviously, you don't have to convert it to cash, which would save you sale costs, for example, and other professional fees. The pitfalls, VAT is a big one. So using a motor vehicle as an example, you should only really deregister for VAT when your asset value falls below 5,000. So you've got a motor vehicle worth 10, and you want to distribute that in specie because you want to keep that motor vehicle for whatever reason. There's going to be a £2,000 VAT bill on that to settle, which effectively will diminish the cash in the liquidation by the same value. But
no different, I guess. To be fair, it's no different than selling it, isn't it, on the open market and charging VAT?
Correct.
But that would be
the advantage of selling it is someone else pays the VAT.
Exactly.
So you might want to sell it and then buy a different vehicle when you're out. But if you want that vehicle, it all depends on the market and the VAT. But it's something that may not be at the forefront of your mind when you think, I'll just keep the asset. The other one is around specifically with trade debts, and sometimes we get it with deferred consideration. People will want to pay the person they've done the original deal with, which is the company. So if you distribute in specie a debt, getting people to recognise that actually they need to pay the shareholder because the debt's moved across can be quite a challenge. Now, there are legal measures you can take, such as putting a deed in place, a deed of assignment, but that does cost money. So sometimes the liquidation might be kept open longer just in case there's insistence to pay the company, and then effectively the debt's already gone, the tax point's already happened. But actually the cash flows through the liquidation, and there could be an additional cost on keeping the liquidation open a little bit longer.
And it's value, if it's deferred consideration, it's valuing it, isn't it? Because you don't quite know. If it's contingent on certain things, then how do you value it, sort of thing?
So it's not all swings and roundabouts. There are other factors to consider, but it's something that's not always known about. That's why we've done a video on it, just to bring to people's attention that you can keep your hands on certain assets within your business. Obviously, they get taxed exactly the same as a capital distribution as if cash was coming out. So you need to fund the personal tax yourself. If the whole company, all the assets are being distributed in specie, that could cause you a different kind of headache. But a big factor to consider when looking at solvent liquidations, for sure.
Good. So distributions in specie, hopefully not too technical. I think you kept it nice and practical.
Probably failed miserably.
Well, it made good sense to me anyway, and I mean, like you say, Jack, it's an effective and quite timely way of dealing with certain assets in the context of solvent liquidations. So excellent, thank you, Jack. Thank you for watching, and I hope you enjoyed the video. Thank you.